We talked to Allison Larson from Novus Mortgage about options for buyers in this financial climate. And with the interest rates rising, what are the options? This is a 3-part series, so she will explain different options to you. Here's part 1.
A lot of us have heard the term seller paid closing costs, but in this market, seller paid closing costs could be used for something that you maybe haven't thought of before. There are now new loan products called 2-1 buydowns that we haven't seen in the market for years. What it is the seller or the builder can contribute closing costs to actually pay the difference in your interest rate for the first few years. So let's say your interest rate is 6% on a 30-year fixed rate. For the first year, they can buy it down for you to 4%, and then the next year, 5%. This could potentially save you hundreds of dollars. If you're wondering if this is the right fit or how you would negotiate this, reach out, we'd love to help.
Here's part 2 of our 3-part series with Allison Larson of Novus Mortgage on how to finance your house a little more affordably in today's market.
There are a lot of products out there for those who have more in down payment to save on their monthly payment for lower interest rate options. But what about for the first-time home buyers just trying to get into their first house that don't have 20% down? One great option is to utilize down payment assistance. Well, why do I need down payment assistance? I already saved up my 5% or 3% down. Well, one way to combat over the next 6 months or 9 months until you can refinance into a lower interest rate, save up your cash and use that cash towards your monthly payment and utilize one of these down payment assistance programs. You can borrow up to $17,000 through Minnesota Housing, and their interest rates are typically actually less expensive than your standard 5%, 10% down product. And then you can keep your 5 or 3% down and use that towards the $200 extra a month your payment might be until you're able to refinance down the road.
Here's part 3 of our 3-part series on how to buy a home more affordably in a higher interest rate market. Check it out.
One great strategy for saving money in a high interest rate environment is an ARM product. This is not the wild, wild west. This is not 2008. ARM products are not a negative thing. Typically, an ARM product is going to be fixed in for a set period of time corresponding with the name of the product. So a 3-year ARM is fixed for 3 years, 5-year ARM, 7-year ARM, even a 10-year ARM. After that period of time, the ARM can adjust up or down by a set fixed rate, typically 1 to 2%, and can only adjust every 6 months or 1 year, depending on the product that you choose. There are a lot of people right now that can save a full percent on their interest rate when they're purchasing by doing a 10-year ARM. What's interesting, most people are only in their mortgage for 6 years, whether they end up selling or refinancing down the road. So a 10-year ARM would protect you that entire time and can save you thousands of dollars up front. If this is something you're interested in, I'd love to chat.